So the dark days continue. While there may be some light on the horizon for the coronavirus crisis, we're not quite there yet. If you're still worried about the toll that it may take on your retirement plan, now is the time to act. It is that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services and also the brand ambassador for the Retirement Income Store. Over the last couple of weeks, we've finally seen some hopeful developments in the coronavirus crisis. Yet at the same time, we've seen the death toll and the economic toll taken by the crisis continue to mount. Unemployment continues to climb, and states are rapidly draining the cash reserves they have available to pay unemployment benefits. With the travel industry at a standstill, oil prices have taken a historic drop, and both retail sales as well as U.S. factory output have reported record declines. So not surprisingly, the extreme stock market volatility we've experienced throughout this crisis has continued. Although the Dow Jones Industrial Average saw a healthy jump in response to some hopeful news about the pandemic a week ago or so, it recently sank again due mainly to the massive sell-off of oil. In short, there are a lot of good, bad, and ugly developments to sort out, and we're going to do exactly that right here on today's show. Once again, We'll do it with an emphasis on what the coronavirus crisis and the emerging corona economy might mean, both in terms of the dangers it poses as well as the opportunities that it may present for you. Joining me again this week will be my co-host, Jeff Small, along with one of our favorite guests, Steve Forbes, editor-in-chief at Forbes magazine. Before we bring in Jeff, let's look at some of the latest key developments in this coronavirus crisis. As of this taping, the number of confirmed coronavirus cases in the United States is almost 850,000, while the number of confirmed deaths is over 46,000. Those milestones will probably be surpassed by the time we actually go to air. However, as I'm sure you know, we've also heard some encouraging news recently that suggests a possible light at the end of the tunnel. Weeks of social distancing across the country has helped flatten the curve for hospitalizations and for new cases. And as a result, lawmakers have become increasingly optimistic about the prospects of reopening the economy soon, or at least portions of the economy. In addition, a new antiviral treatment by drug maker Gilead is reportedly boosting COVID-19 recovery times, and prospects for a vaccine have been improving. As a result of some of these hopeful signs, the stock market saw a slight jump just one day after the release of several not-so-hopeful economics reports more than a week ago. Since the economic stoppage began, over 20 million Americans have filed for unemployment. On April 16th, the Conference Board reported that its index of leading economic indicators, otherwise known as the LEI, fell by nearly 7%. Now, this is the biggest decline we've seen in its 60-year history. In addition, retail sales suffered a record drop in March, and output by factories declined by the largest margin since, get this, 1946. Now, as I've discussed before, the stock market's ability to temporarily shrug off these hard realities and pare some losses may continue yet for a while. This, in my opinion, gives investors in or nearing retirement the potential opportunity to reduce their market exposure before the next major correction takes hold. Because once that happens, investors who get caught in the downdraft could end up seeing their portfolio shrink by over 55%. And according to history, possibly as much as 80%. And we'll talk about this more coming up in just a bit right here on the show. And right now, let's welcome my co-host, Jeff Small. He's the brand ambassador for the Retirement Income Store, as well as president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also the Amazon best-selling author of the book, Turning Financial Planning a Right Side Up. Jeff, great to have you back in the show, my man.
Hey, Dave, it's great to see you. We got so much fun stuff to discuss today.
Yeah, I mean, gosh, past week we've had unemployment now is officially lingering around 20%, which is more than double what it was in 2008 during the Great Recession. And it's only, from what I understand, about 5 percentage points shy of where it was during the Great Depression. I think we hit, 25% then on unemployment, and we're at 20 now. Scary stuff.
It's really scary, but David, the stock market doesn't care. It does not care. As Stephen Mnuchin said 3 or 4 weeks ago, it doesn't matter what happens to unemployment, the market will do what it wants. And the stock market valuations are completely ignoring that fact and disconnected from the unemployment numbers and the fact that there's going to be millions more unemployed in the next couple of weeks.
So we talk about why that is all the time, but think about it. During the financial crisis with a 10% unemployment, we had a stock market drop of 56%, I believe it was, on the S&P 500. And although the S&P didn't exist during the Great Depression, the Dow dropped, I believe it was, by 90%, with an unemployment rate that's only 5% higher than we are today. So why is it the market seems to be so numb to what's going on?
Well, honestly, there's 2 dynamics that are affecting that, the answer to that question, Dave. The first one is the market's forward-looking, like you always teach our viewership and our listeners on the show. It's forward-looking. It factors in prices. So it's assuming the market's going to recover, the economy's going to recover, the economy's going to recover quicker. The second thing is we've never had the Fed all in. The Fed is all in behind the markets. And everyone's discounting the fact that there's going to be potential bankruptcies and failures as we unwind through this corona economy. So those are the 2 reasons.
I wonder though what happens. I think part of it is people are expecting this V-shaped recovery. We're going to go back. The market's going to come back. The economy is going to come back. But it looks like they're pushing to get back too soon. So I want to ask you, but also I can't wait to ask Steve Forbes when he comes on, is, what does that mean? If we come back too soon and we have another leg of infections, and next time we're out for 2 months, does that negate everything the Fed's doing as far as the stock market's concerned?
I think it does. I don't think it matters that, everything is dropping and we have the worst economic data, and it's absolutely terrible. The data is the worst we're ever going to see in our lifetimes. But I don't think it's going to affect market valuations because we know we're going to pop up out of this. This was not caused by cyclical economics. It was caused by a pandemic or what we call an act of God or a black swan event. And so everybody expects this to come right back up. And I'm sure Steve will have some great comments on that.
So do you personally believe, I know you believe there's going to be another down leg, but do you personally believe we're just going to maybe test the lows of March, where maybe we're down about almost 40% from the high? Or do you think we're going to make new lows?
Well, that's the question that everybody wants an answer to. Nobody really knows. And so what we do know now is the market is more irrational than it ever has been. And that irrationality may continue. We may not retest the lows. We may not have a drop from here, David, no matter how bad the numbers are, because we know they're going to bottom out. And we know the Fed is completely behind the markets and making companies solvent and saving industries and saving the corporate bond and municipal bond markets. And so that's just where we are today. We've never been in an environment where we've lost so many jobs, had such horrible data, but have the Fed be completely in and such optimism forward-looking, even though you and I both know that optimism is not realistic. We know the economy is going to completely change, and that's global and domestic.
Well, that's why, and I guess you and I are a little different here. You're a little more optimistic than I am. I believe we are going to make new lows. I guess we're going to have to let Steve Forbes settle this argument when he comes on. But, I know you and I have talked in the past, though, about the fact that just because the Fed is flooding the economy with all this money doesn't necessarily mean people are going to go out and spend it right away. And I mean, that could stretch things out a lot longer, right?
Well, you're exactly right. But even though we have this demand destruction and economic destruction occurring right before our eyes, what's happening? The markets are going up.
Yeah.
It makes no sense. It's completely irrational.
Yeah, it is irrational. And I think the most important thing I want to see our viewers and I want to see our listeners really understand is that I don't think this is a time, as most advisors or brokers would say, they often say, buy the dips, buy the dips. I think this is more of a time to sell the peaks. Because right now, there is a disconnect, as you said, Jeff, between the market and between the economy. and the market has a chance of habit of retracing 50%. It hit a low, it just retraced more than 50%. Heck, it retraced 2/3. So now how low the next low is going to be, we really don't know. So isn't it just a great opportunity for people to take some of their winnings off the table if they're part of the income generation?
Oh, there's no doubt. The income generation can't play the recovery game like we did in 2008, like we did from 2000 on the dot-com bust, where people saw their valuations drop by more than 50%, and then they had to wait several years just to get back to break even. If you're retired, David, you're exactly right. Now is the time to de-risk at these peaks again in this bear market rally, because technically we're still in a bear.
Well, even us, our risk profiles change. Even now we're not that close to retirement. The reality is we were barely 40 years old in 2008, and now we're up, or during the financial crisis, now we're up toward our mid-50s. So even in our own philosophies, I've seen that changed for me and how I handle my investments. I'm sure you have too, right?
Oh, there's no doubt. But David, thank you for reminding me how old I am. I appreciate that.
Yeah, well, sometimes I have to. And so our viewers know, I do want you to know this, that although Jeff may look a lot younger than me, he's really only 1 year younger than me. I guess, Jeff, I'll give you a compliment. You do age more gracefully. I'm a little grayer and a little older, but then again, heck, with your hairdo, we don't even know if you're gray or not. So I guess you could be fooling us all.
Those are all really good points, Dave, no doubt.
Well, again, we have Steve Forbes coming up in just a minute. And I know, Jeff, you've got a lot of great political questions for Steve in terms of how this is going to affect the election in November. But I also can't wait to talk to him about the economy, talk to him about the stock market, see what he thinks, or is the stock market bottom in, as a lot of the talking heads on TV seem to believe. So let's take the much needed commercial break that we have to do to keep our sponsors happy. And let's come back and let's interview Steve Forbes. So you stay with us too. Don't go anywhere. Steve Forbes coming up in just a minute right here on the Income Generation. We'll be right back. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan. Now, as I mentioned, with a few hopeful developments in the coronavirus crisis over the last few weeks, the stock market week before last actually saw a spike. In fact, after being down nearly 40% at one point, the market has recovered more than 2/3 of its losses. This has even prompted some bullish forecasters to proclaim that the worst is over for Wall Street. Well, with all due respect to those forecasters, that prediction makes absolutely no sense to me. Despite any hopeful signs, I believe the hard economic data suggests this market still has a lot further to fall in order to align itself with reality. I've mentioned some of that data already, but here's one more example. Some leading economists are predicting that the unemployment rate, which is currently about 20%, could ultimately climb as high as 30%. Now consider that at the height of the Great Recession, unemployment peaked at about 10%. And during the Great Depression, it was only maximum about 25%. Also remember that in conjunction with the financial crisis and the Great Recession, the stock market underwent a correction of nearly 60%. 8%. So although we may continue to see spikes in response to hopeful headlines or moves by the Fed, I believe the economic realities of this crisis will continue to pull the market more decisively downward. And this cycle is something that some call backfilling. It's a typical pattern for a market on the verge of a major correction. When the market's trending downward, it backfills and bounces back at least halfway before the next down leg actually occurs. And we've seen this recently. Again, a few days after its spike, the market tumbled again when crude oil prices fell into negative territory for the first time in history. To talk more about this, let's bring back in Jeff Small, but we also want to welcome back Steve Forbes. He's one of our favorite guests here on The Income Generation. He's also editor-in-chief of Forbes magazine. Steve, thanks so much for joining us today.
Good to be with you. Thank you.
You're very welcome. Okay, we have so much to talk about. I want to get your feedback on, and do you think we're going about preventing the spread of this virus properly? What do you think it's going to mean for the economy, for the stock market? And then my co-host, Jeff Small, I know he's chomping at the bit, just waiting to ask you questions about how you think this is going to affect the president in November. So let's start with how we're coping with this. I know you're not a doctor per se, but you're a smart guy. Do you think we're handling it properly? Do you think we're threatening to maybe go back to work too soon?
Well, I think the way they're approaching it is the right one, and that is to allow each state, even a city, to determine how they're going to come out of this thing, get to the other side, as they say. New York City, very, very densely populated. New Jersey, where I live, the most densely populated state in the union. Very different from, say, South Dakota or Oklahoma, where they have a much more open policy, or parts of Florida and Texas. We'll see what happens in Georgia. So you have to let each one do it. And I think there's more testing that needs to be done so we get sounder conditions and data to be able to make these decisions. But the American people want to get back to work. We want to get this economy starting to move again. Mm-hmm. So I think it can be done in a prudent fashion, but it's going to be not one size fits all. You're going to see different things done in different parts of the country.
Mm-hmm. So speaking about the economy, the issue then becomes, okay, if this were it, if we had a vaccine or a cure today, we'd have a V-shaped recovery, things would pop right back. But now we go back to work gradually. There's still some industries that aren't going to really come back in full for a long, long time. And there's always the threat that we go back too soon. We have another wave of infections. We're back out again. And the economy just drags on that much longer. So what are your thoughts overall economically and with the stock market in terms of how you see this playing out, just looking at it where you are today?
Well, there are going to be parts of the economy that obviously are going to bounce back far faster than other parts. We all know what's happened to the travel industry, the energy industry, and certain other industries. And that's going to be a while. They're going to have to, airlines are going to have to do some very creative things, perhaps in the architecture of the plane. But I think the economy as a whole will start to come back. And the key thing is, this gets to the campaign in November. What kind of an economy are we going to have next year? What kind of environment are we going to have next year? Mm. If we have a positive environment of tax cuts, deregulation, and having a sound dollar, that would create, I think, conditions for a very booming economy next year. And I think the economy will heal far faster than some skeptics think. But if we go with the old way of the Democrats, which is raising taxes, putting on more regulations, one size fits all, we're going to have a very disappointing recovery. Okay. And unemployment's not going to bounce back the way it should.
Okay, now that's the perfect cue for my partner, Jeff, to take over and ask you some political questions. But before we do, gut instinct. What's your gut instinct? Have we seen the lows in the stock market for this year? Do you think we'll test those lows, or do you think we'll go lower?
Oh, I think you could see points where you get scares about this thing coming back again, and the market could take a hit. But I think the market tries to anticipate the future. And if it looks like the Republicans are going to do well in November, I think the market will reflect that. But if it fears that the Democrats might get in, you will see a downward trend. The market wants to know what lies ahead. And I think it's done quite well from the lows, precisely because they think there's hope that we will get out of this thing. Various parts of the country starting to come back again. Sure. One of the things I hope that President Trump does is push for a payroll tax suspension, 15%, You make $40,000-$50,000 a year. That's a $3,000 or $4,000 raise for employers. That's a $500 billion of less labor costs. So it's win-win, easy to administer. And I think that would be a good way to get the economy in a very good launch pad for later this year and also going into 2021. And I think he could shame the Democrats in the House to go along with it. Nancy Pelosi, Nancy Antoinette, eating her ice cream. Is she going to resist giving people a $3,000 or $4,000 raise? I don't think so at the end of the day.
So great. So since we're on politics, and I know that Jeff Small is sitting in the Melbourne studio just like a caged animal now and wants to talk about politics, go ahead, Jeff. I'm handing it over to you.
Hey, Steve, it's Jeff Small here. Hey, listen, I look at President Trump as being almost Teflon because they've put him through so much, and he always seems to find a way to turn lemon into lemonades to his advantage because he's got such a high intellect and he's so smart. What do you foresee happening with the election in the fall? Because we just lost 26 million jobs. Going to lose a lot more than that when this is all said and done. The virus is an unknown thing. It's a black swan event. Historically, that's usually bad news for an incumbent. So tell me what your viewpoints are. Is the president at jeopardy for not winning the re-election because of these economic issues and because of the coronavirus issues?
The answer is no. Everyone knew that the economy was doing well before this health disaster came along. And most people now accept that China was responsible for it. They could have contained this thing early on. So that's not the president's fault. The question is, how is he dealing with it? And despite some missteps, because remember, there was no playbook here. This is unprecedented. I think people see that he is in command. And the fact that he brings experts on the stage when he does his daily briefings is very reassuring. And he also goes out of his way to thank people who have been doing great things, whether it's truckers, online people in healthcare. He always shares, he doesn't try to say it's all me. He always points his finger and praises those who are out there doing the real work to get this economy through this, and the country through this crisis. I think people like that in a leader, one who can bring teams together to get big things done and knows how to share the praise, shower out the praise, you might say, to those who are doing extraordinary things. I think that's a side of Trump they didn't see before.
It's definitely a side they didn't see before. I guess I just get concerned a little bit because I see it's almost like a lose-lose situation where the Democrats could turn around and say, well, we go back too early and there's a second wave of infections. Well, then, hey, he cared more about the almighty dollar than he did about human lives. Conversely, if he stretches it out longer, then the economy will really be disrupted by November. So all I can say is, I hope you're right. I hope you're right. We need to take a quick commercial break. We'll be back in a minute with more words of wisdom from our good friend, Steve Forbes. We'll be right back here on The Income Generation. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan. Before we talk more with Steve Forbes, let's briefly look at a few of the other good, bad, and ugly recent developments in the coronavirus crisis. As for the good, this past week, Congress reportedly reached a deal on a nearly $500 billion interim coronavirus bill that includes additional funds for the Small Business Loan Program, in addition to more money for hospitals and testing. The bill was expected to be passed and signed into law by the president by the end of the week. It follows the $2 trillion CARES Act passed by Congress just a few weeks ago, which was the largest such economic relief package in American history. Despite that, more federal relief efforts will likely be needed when you consider some of the mounting bad news. For example, it was reported just this week that nearly 50% of states, including California, New York, Massachusetts, have drained almost half of their total reserves for funding unemployment payments for people out of work due to the pandemic. With unemployment still rising week after week, economists say states could soon run out of money and need federal loans. As for the ugly part, As you probably know, protests against the economic shutdown and social distancing mandates broke out in several states this past week. While the frustration is understandable, many health experts agree these kinds of gatherings could undermine the great progress we've made so far in flattening the curve of this infection. Naturally, that would only prolong the need for social distancing and resulting economic pain. Now it's time to welcome back my co-host Jeff Small, along with Steve Forbes, editor-in-chief of Forbes magazine. Steve, thanks so much for sticking around.
Good to be with you. Thank you.
And you know, I really apologize. We had to take one of those pesky commercial breaks. You guys were on a roll with such a great political conversation. So Jeff, Steve, take it away.
Well, Steve, you know, I've been watching these coronavirus updates by the White House every day, and they've been rather impressive. But one of the things that's impressed me the most, and just to shift gears here and downplay some of the serious stuff, is how intelligent President Trump is. He is just one tough negotiator, and I think that's an X factor that everybody underestimates him on, that he is incredible. His intellect is very high. You know, would you agree with that?
Well, I think what a couple of things are happening here. One is he's holding a virtual press conference every day. And while they have some real jousting there, what it does is this prepares him for the main event in November. When those debates come, when he is dealing with the press and during the campaign, he's going to be ready for prime time, whereas Joe Biden is just going to be starting to dance around the ring and not going to be ready for the big bout. So he's going to be ready for it. The public has seen a lot of him. And I think what the public has been impressed with is the way he brings other people in. He thanks people. He's always thanking the frontline workers. He thanked the truckers the other day. It's not just the Donald Trump show. He brings other people in. He has them by his side during these pressers. And I think that shows that he has put together a very capable team. And that shows that he recognizes that this is not just about him. This is about the country as a whole, the people who make this country work. And I think that's beginning to get through to people. This guy understands far better than the Democrats eating their ice cream what makes this country tick.
I think before it was funny because, you know, I think a lot of the Democrats accused him of lacking humility, but you're absolutely right. What we've seen now is actually much more humility as he's saying, look, I'm not a medical doctor. I'm not an expert in infectious disease or an expert there. Let me bring these people in. My only worry is that it's like a lose-lose situation. It's almost like, okay, the economy gets going, but we get another wave of infections and deaths. And then, you know, that's a pawn that the Democrats can use against them. But on the other hand, if he waits too long and gets everyone back, and then the economy is doing really poorly around November, they'll use that against him. So my concern is it could be a lose-lose, and I certainly hope not, because we all want to see him get back in.
I think he's going to dominate the campaign platform, so to speak, setting the agenda. All the Democrats have been able to say nothing you do is right. And now they're even talking about another investigation, which I think the public is fairly sick of right now. They want action, things done, not another fruitless investigation, whether like Russian collusion and the impeachment fiasco and other things. People want real things done. And this guy's dealing with an unprecedented crisis. There were no playbooks on this. We've never had anything like this before. And so I think the public will cut him a lot of slack. And in terms of opening up the economy, people want to get back to intermingling with people. A poll was taken recently and found that 50% of the people want to be able to mix with other people, even more than going back to their jobs. They want to be able to mix again. And I think that's going to be something you're going to see in more and more states around the country, again, at different timetables. Sure. But people are not going to blame him for the fact this disease is still out there. You'd almost think that he invented the disease in Trump Tower and loosed it on the American people the way they talk. I think most voters are going to see through that.
So now you have, I know you're hoping that in his second term, we'd be able to get tax cuts 102. Now with all the debt we're taking on, do you think that might preclude him, should he get reelected, from actually having another round of tax cuts per se and getting it through Congress?
This gets to the question, how do you create the environment for a revived economy? Maximum economic growth, job creation, incomes rising.
Sure.
And I think that putting on taxes is going to give us what we had after 2008, which was the worst recovery from a sharp downturn just about in American history. So the debt itself is not going to preclude tax cuts. After World War II, we had debt higher today proportionately than concerning the economy.
True.
What did we do? We virtually cut household income taxes in half, deregulated, put in a great college program, the GI Bill of Rights, put in labor reforms, got rid of all wartime controls, which the experts said we shouldn't have done. We did it anyway. And by golly, over 10 million veterans quickly demobilized, went into the workforce, and our unemployment rate remained low. And that's what you get with a revived economy. And that's what we're going to have here. You want a stagnant economy and high unemployment, or do you want a vigorous economy that can get people back on their feet again?
Steve, in 45 seconds, we've heard the president hint toward the fact that this could be a virus that China created. Do you think that when this whole thing shakes out, that we could end up becoming a little bit more isolationist, or at bare minimum, it hurts all the trade developments we've made so far with China?
I think you're going to see readjustments just because smart business people want to have supply chains that they don't think are going to be subject to interruptions. And China's shown that it's not been a reliable partner in that respect. As for the source of the disease, I think it's becoming clearer and clearer. It came out of that laboratory in Wuhan. They were doing experiments, doing research on bats. And because of carelessness, lack of safety, it ended up getting into the general population. And I think people are going to be holding China accountable for that. You already see states like Missouri and Mississippi and others are going to sue China. I don't know where those suits are going to go, but it underscores the fact this did not need to happen.
Wow. Well, I got to say, I really appreciate you being here with us today, as usual. Time flies when you're having fun. But in closing, I want to say this. I'm glad to see you coming around now and being in the Trump camp. I know you were in mourning for a while right after Bernie Sanders dropped out of the race. But I'm glad to see a smile back on your face, and you're supporting the president as you should be. So again, Steve, thanks so much for being here with us.
Bernie Sanders will become a TV commentator where it's just words and not policies.
That would be a great place for him, wouldn't it? I love it. Steve, thanks so much once again. You stay with us too. We have more coming up here in just a moment, right here on the Income Generation. We'll be right back.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved, it's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
And welcome back to the show. I'm David Scranton, and we're here with Jeff Small. Jeff, so did you know that Steve Forbes was a Bernie Sanders supporter? Did you know that before you heard me say it?
David, I was shocked and shaken by that. I could not believe that.
Well, while we're self-isolating, you're self-isolating in your studio, I'm self-isolating in mine. We at least have to make some fun and have some humor with it. I'm glad we got Steve to laugh at all that. So it's interesting, you pushed a couple times. You said, you're talking about the president's intelligence, and of course he gets a lot of flack, sometimes because of the way he talks, trying to talk to the average American. That, quite frankly, because he likes it, he tries not to talk over people's head. So he actually talks to maybe not even the average American, but maybe even the below average American in terms of intelligence. But he does it on purpose. He wants everybody to understand his message. So he gets a lot of flack for, sometimes people think, gee, he's not that smart. But as you said, he really, really is. I was surprised to see that Steve didn't bite on that. But he is a big Trump supporter, so he must believe that, right?
I think that Steve is more about common sense economics, and that, if you're on the right side of the political spectrum, we apply common sense policies that will enhance economic output of the country from the bottom up. And that's what President Trump has done. That's why the economy was so successful, since his presidency in November of 16.
Yeah. Well, it's interesting because, as you and he talked about, I think it is a great thing to show that humility, that he is actually bringing in other people now into the conversation. And that takes some ammunition, I believe, away from the Democrats, because, I think they tried to paint him as somebody who, and he can come across this way, so it wasn't just the Democrats, but everybody was painting him as somebody who just was arrogant and all about himself. And now I think he's starting to show that that's really not the true Donald Trump, right?
No, it really isn't. I think he really rolled up his sleeves and he worked for every American during this coronavirus, emergency, this silent war that we have, this silent killer, because it really is unprecedented what we're going through. I could not be more impressed with what he's mobilized, the team of advisors that he has. As you said in the first part of our clip today, his intelligence factor, I was so impressed with. He is so super smart. He is not one guy I would want to negotiate with, I can tell you that.
Yeah, well, smart or not, I agree that I would not want to negotiate against the president. Right from the art of the deal from over 30 years ago, I made that decision, not wanting to do that. So when you were talking to him, as one previous Bernie Sanders supporter to another, now that he's out of the race, Jeff, do you agree that we're at a situation now where he's got the best shot of, should he get reelected, really, getting people back to work quickly and doing the things that Steve Forbes said are necessary to getting the economy back to normal as soon as possible?
I really do. I think you've got to have a business person in the White House. You have to have that business acumen and that insight that he has, that's, part of this, being in the system and out of the system and understanding how that works. And so if we have a politician in there that doesn't have the experience, well, how are they going to fix things? If they don't have the experience, people are only as good as their training. That's one of my favorite go-to statements. You've got to have the training. You've got to have the experience. President Trump has that. And what, love him or hate him, he's got that acumen. And so that's got to trump at the end of the day what's best for our country financially. No pun intended, Trump, I said.
It's kind of funny because in this, and by the way, thanks for not taking the bait that I tried to throw at you about the Bernie Sanders comments. But it is kind of funny because I'm sure I'll catch some flack. As you know, we run the show not just on Newsmax TV, which is a pretty conservative crowd, but also it's part of our syndicated radio show, which runs in all different markets across the country. So I'm sure I'm going to get some good pushback for all that. But what else do you think about what Steve said? Anything he said that you disagree with, that you think you might have an opposing point to?
No, I completely agree with a lot of his points. I especially I thought I really wanted to key on for a second what he said about what would happen if the country goes Democratic and we have regulation and taxes that are going to increase. I mean, the platform for the Democrats has been destroyed as a result of the virus. And if they stick to that same platform of increasing taxes and going after Wall Street and adding regulations, they will crush the economy. And so in some odd way, this lemon that we're going through with the pandemic can't be turned into lemonade. And so common sense people are going to say, look, we've got to have somebody that can't do that to the economy. If they suggest that, then we've got big problems with the economy going forward if the Democrats get in.
Yeah, it's certainly bad timing to be raising taxes. It will stifle the economy, and nobody can argue with that, Republican or Democrat. So we need to take another commercial break, but when we come back, okay, Jeff and I are going to talk about the things that you need to know in order to protect yourself in the real world during this corona economy. Whether we get another down leg or not, whether we go back to work and there's more infections and we get back to having a self-quarantine, we're going to tell you what you need to know coming up right after the break. Stay with us. We'll be right back. Welcome back. I'm David Scranton here with co-host Jeff Small. Welcome back to the Income Generation. So Jeff, again, I think advisors who say, buy the dips right now are absolutely crazy because the trend of the market seems to be downward. We did normal backfilling by coming back up more than 50%, filling the gap halfway. I think it's really time to, if anything, not buy the dips, but to sell the peaks.
Yeah, I would agree with that, Dave. I think that the current market values are a gift if you've ridden this roller coaster ride we've been on for the last 2 months. And especially for the Income Generation viewers and listeners, the most important message we can deliver for you is that if you're 55 plus and you need to transition from the accumulation phase to the conservation phase, which means you de-risk, because the risk reward the next 10 to 15 years just is not going to be there as we try and rebuild the economy or reset in terms of what's going to be left in the economy.
And
Dave.
it doesn't mean that you can't be a capitalist. You at the end of the day, if you say, well, gosh, I should only have 40% in the market, not 70, because I'm, a certain number of years from retirement, you might want to go down more than 40. You can say, sure, I can go to my 40% where I should be at this stage, but you can actually go lower. You can go to 20%. And what that does is that gives you an ability to become a capitalist. That if I'm correct and this next major drop happens and we create new lows, now you can take some of that money and put it back in at the low. But if you just go back to where you should be, let's say in my example at 40%, then if the market drops, you can't really double down. You can't become a capitalist. You can't take advantage of it. And at the end of the day, you want to protect yourself, but you don't want to be out of the game. I mean, Jeff, I see this every day where clients come in, and I've got a client that I talk to now every week, and he's in his 80s, but he still wants to be in the game. He wants to be a capitalist. He knows he wants to be conservative, but he wants to be a capitalist in a smart way. So, and I'm sure you see the same thing too, and right now is a great opportunity really to be a bit of both, right?
Well, it is, and so you have to understand that if you're going to put money at risk, it has to be money that you can live without and that you don't need to create income. And that's when we run the numbers, Dave, that's what the numbers say. And so it's not a philosophy or a theory, it's what the math says. And the risk reward just isn't there, but you can still take advantage of the current depressed prices because we are still depressed from the peaks by about 15% right now.
I also want you as part of the Income Generation to know that there are things that you could take advantage of that are benefits. I've heard people say, gosh, I know I've gotten laid off, but I don't want to apply for unemployment. It's almost as though they think it's unmanly or un-American to do it. Well, it's not. If you're going through this right now with the rest of us, it's money that is due to you. Take it. And the same is true for the CARES Act and the new tax benefits that are available. In fact, next week we're dedicating our entire show. We have Ed Slott, who's America's IRA guru on, who Jeff and I are going to interview, who is going to answer questions about all the new tax benefits that are available to you, members of the Income Generation, as part of the CARES Act. So you're going to want to be with us next week. But for now, we need to take a commercial break. Stay with us. We have more to go. We'll be right back. I'd like to thank all of my guests for joining us today for another episode of The Income Generation. Most importantly, I want to thank you, our new and returning viewers. Although we may finally be seeing some light at the end of the coronavirus tunnel, fully illuminating that light won't be as easy as flipping a switch. Returning to normal will be a gradual and possibly frustrating process. Even then, it'll be a new norm, with some of the changes now remaining permanent. Some businesses, for example, won't come back, and even some entire industries will continue to struggle for a while. The disposable income people had a few months ago to spend on dinners, vacations, gifts won't be there any longer for everyone as they look for new jobs and try to stretch every penny. The psychological wounds this crisis is inflicting will also take a long time to heal, and that too will slow the economic recovery. The point is, while we're all eager to pick up and get on with our lives, we need to prepare ourselves now for the reality that it probably won't be that simple. In the process of preparing psychologically, we should also be prepared from a practical standpoint as much as possible. For Americans in or nearing retirement, meaning within 10 years of retirement or so. That means making sure your retirement plan is modernized for the new Corona economy. It means staying informed, understanding your options, and making sure your portfolio is as protected as it can possibly be against historic levels of stock market volatility and against the possibility of another major correction of 55% or more from the peak. Again, stay safe, everyone, in every way possible, and thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential you stay informed and up to date, and as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.